The decision to remove 5 Singapore blue chip stocks from the closely watched MSCI Global Standard Index saw the STI fall by 0.7% last Wednesday. In fact, the STI was one of the worst performing gauges in the region after news that City Developments Limited, Jardine C&C, Mapletree Logistics Trust, Mapletree Pan Asia Commercial Trust and Seatrium will leave the MSCI Singapore Index from May 31st. Welcome to Money and Me. I'm Michelle Martin in conversation today with a fund manager with a big personality. I saw him in action in a public dialogue and thought I have to have him on. Anand Francis is Senior Investment Strategist from Infinity Financial Advisory. Good morning, Anand.
Good morning, Michelle.
Great to have you with us. Good.
Thank you.
What is your overall assessment of the deletions in the latest MSCI quarterly review with regards to Singapore? Do you think these deletions were anticipated by the market or did they come as a surprise?
I think it definitely came as a surprise. I think the reaction to it was also a bit overdone. So I think everyone needs to understand what indexes are and how fund managers use them. So I think the sell-off was a bit excessive. Yes, it was a bit of a surprise when these deletions came along.
Okay, that's a good point, that people need to understand how fund managers use these indexes. As a fund manager, do they align with or diverge from previous MSCI reviews in your view? And maybe you can talk a little bit about how these indexes typically are used.
Well, fund managers use indexes as a benchmark to their performances. Or they will say, okay, if MSCI has got these stocks in a country which I am not familiar with, then I will probably have to buy the stocks. And if their performance or the remuneration is basically benchmarked against these indexes, then if they do better than these indexes, then they basically know what their reference index is. That's what an index is about. That's how fund managers use it. So when names are dropped from an index, that's when fund managers actually divest from certain stocks. So these instances, or I think if you don't manage the news or the media rollout properly, it tends to formulate a little bit of panic within the market. If you invest in stocks because they're good companies, not because they're on an index. And that needs to be the primary reason why you invest in stocks. If Seatrium and CDL are good companies, for example, and I think they are, good cash flow and good earnings growth, you should continue investing in them, not just sell them off just because they're not on an index.
Okay, fair enough. We do know that these are critical decision support tools. And I think when people hear that, ETFs are going to divest, for example, from these funds, many of them will. The question is, what does this mean? Not just in the short term, but in the long term. So if we look at maybe City Developments Limited, Jardine C&C, how have they been affected by their deletion from the MSCI index so far, in your view?
I don't think they will be affected because it's a going concern. There are companies. They will probably have to work a little bit harder to get into institutional support or institutional investment into the capital structure. But apart from that, I think as a going concern, these companies are still good. I mean, they run properly. Their earnings are growing steadily. Yes, affected since COVID, but they're growing and they're recovering from the effects of COVID. So if they're good companies, you should continue investing in them. But that, again, depends on your or the investor's personal understanding of how the company is run. So fund managers need to do their own research. So if they do their own research and they do their primary research, they find out that these companies actually have good earnings or good growth, good earnings growth, and they have a future long-term going concern business, then they should just basically invest in them.
So your thoughts on the immediate impact on Seatrium stock price, for example, or investor sentiment?
Well, investor sentiment definitely was hit. Okay, if you don't, the other thing is you need to know where the deletion came about. I think the deletion came about from the global, what's it called again? Global global standards. So generally, the global standards index is a reference to emerging market indexes or emerging market standards. So in that index, if you've noticed that there was a reduction in Chinese and Singaporean stocks, and there's an increase in Indian companies in the index. So this depends. See, we're totally relying on MSCI to make these decisions. Seatrium is a good company. I mean, the consolidation and the merger, and they have some past issues or legacy issues within the company, but they are a good company. Not many companies have that sort of reach or business reach that Seatrium has. So yes, initially the sentiment may be hit, but if they're a good company and if an investor feels that this basically has got a good runway in the future, they should go right ahead and do it. I mean, the logistic business is not going to stop, right? Shipping is not going to stop. So if these companies are run efficiently and they're basically inducing, they will perform better or will perform in the long run, then you might as well invest in them.
How do you think the moves could impact other allocations to the Singapore market by index funds?
I don't think pulling out from an emerging market index is an issue, or an index which has an emerging market slant is an issue. Singapore is a developed economy, and we basically need to worry whether our main stocks or the high capitalized stocks in the larger indexes stay where they are. And I think they will continue going on. So, if these companies that were excluded from which I feel is a emerging market slant index or slanted towards an emerging market thought process, then if they can be included into a more large cap index or Asian index or all country world index, then, it'll be good for them. So maybe it's a transition. We don't know because these decisions are made by MSCI and they're not very, very clear about whether it's a capitalized way to the index or what's the arc behind the deletion and all that sort of stuff.
So the new look of the index is even more concentrated on banks. What are your thoughts on the stronger focus on banks? Well,
I'm not surprised. I'm actually not surprised that there is a high concentration on banks, and this would probably lead on to the segue into our next question, which would be why is everybody moving into where SAs are, where the funds are going. Banks are strong in Asia. Okay, they're well capitalized, especially in emerging markets. So after the global financial crisis, there's been quite a lot of regulation and structure that's been put into the finance industry, Singapore included. And we've got really, really strong banks in Singapore, world class, for example. So yes, I'm not surprised that because there's a lot more regulatory oversight. There's quite a lot. They've got quite a lot of capital and assets, and the business is actually growing. And in Asia, like in India, for example, you see a lot of people basically understanding banking or getting a bank account for the first time and using bank services for the first time, and the services that are provided by banks are basically reaching far reaches of society, or further reaches of society than before. So I think banks basically have some growth within Asia. So I'm not surprised that they're growing.
So India's weight in the MSCI Global Standard Index has risen, and some say that's going to boost the prospects for more inflows into its equity market. On the flip side, dozens of Chinese stocks have been cut from the global benchmark. So in terms of global fund managers' allocations, what are you seeing in terms of where allocations are being trimmed or raised?
Well, exactly like how the trimming has happened in the indexes, that's actually happening out there in Asia. So there has been some trimming of Chinese stocks, and there's an increase of allocation to India. There is actually a higher allocation to China plus one countries. China plus one countries would be countries like Japan, Korea, Vietnam, ASEAN. So you're seeing a little bit of flow within Asia towards these countries. Korea, Taiwan are major beneficiaries. They're doing very, very well. Japan is also doing very, very well. India is also doing very well. So there are pockets of growth within Asia, not in totality, but within sectors within Asia. So when previously we used to talk about, which country, and then we allocate assets to that country, or we buy a broad index representing that country, Asia has developed and Asia has moved on. So like your previous question you asked, why finance? So the question you need to ask right now is which sector within Asia is doing well? So the flows are going towards stronger sectors or sectors within Asia which are basically world quality.
I suppose the next question would be, which sectors are you referring to? You set up your own question.
Well, you see, China is still the best place to manufacture, and the operational efficiency China has is unsurmountable. So from there, I mean, the higher end of technology will probably be moved to Korea or Japan. So silicon production, we know, with AI, with artificial intelligence, I got to be very careful with AI because a lot of people actually misinterpret accredited investor and artificial intelligence. So artificial intelligence, because of artificial intelligence, the hardware required to basically develop the industry is quite a lot of it's actually coming from Asia. So you've got Taiwan, we've got Japan, we've got Korea, but the base layer or the initial production is still with China. So that's why I said China plus one. So you're seeing the hardware, lower end of technology production, mid-level and super high level of technology production still has a very large Asian component to it. So identifying these companies or these sectors is very, very important at this point in time.
You mentioned technology. You mentioned silicon production. In terms of, if we look beyond Asia, we see a lot of inflows into commodities, right? Seen as a hedge in this high interest rate environment. We've seen the price of copper really skyrocket as more people look at what's important for the green transition and metals that might be important there. So what is your general take on commodities in this particular economic time?
I think this question, I wouldn't link it to production too much. Let's go back to gold, for example. I mean, the run-up in gold coincided with the realization that inflation is sticky and interest rates are going to stay high. So, I mean, a lot of people didn't correlate these two. So, the rise in commodities is usually linked to if there's inflationary pressure. So, I think the fact that the markets finally realized that inflation is here to stay, we're seeing a lot of these core materials or commodities linked with production or development, or new age development or the new technology and all that. That's why you're seeing all these commodities, the prices are going up. So they are correlating to the market expectation of where inflation is going to be, or is probably going to stay on.
Are you seeing a notable rotation into materials and energy and industrials?
I think energy, we've got no choice, because if artificial intelligence is going to be the mainstay of growth going forward, then we will need energy. Okay, the move away from ESG, ESG is kind of taken a back seat a little bit when it comes to energy production, because we need energy for artificial intelligence and the development of it. We need a lot of raw material also to basically catch up with the need of artificial intelligence. So we're seeing these. It's a total shift. It's a paradigm shift where investments are going.
In terms of interest rates, just last week, Fed Reserve Chair Jerome Powell said it may take longer than expected for higher interest rates to lower inflation. And he gave no hint that a recently slowing labor market could mean earlier rate cuts. So in terms of impact of this on sentiment, what are you seeing?
Well, we did not expect rate cuts, or when we basically spoke to our clients and we were looking at things, we kind of told our clients that we were not expecting rate cuts.
Interesting.
Until the last quarter of this year. So we're right smack. So we've come back. So market expectations and what we've been telling our clients since last year have aligned. So what everyone needs to realize is inflation is probably going to stick around for a while because there is this whole cycle. There's a vicious cycle of wage growth and expectation of, I'm going to spend more, so I need to get a higher paycheck. You have that sort of vicious cycle. That vicious cycle needs to stop. That cycle needs to stop, and then people need to start realizing it's going to be more expensive to maintain their lifestyle, and then that's going to be a pullback. So that's exactly what the Fed is saying. They're saying that it will take a while for people to realize that they can't afford the current lifestyle they're in because things are expensive. So it will take a while for interest rates to bite. So when people say higher for longer, you should expect it because we were close to zero. Even if they cut, interest rates are still going to be around 4.5, and that's still high. And people need to understand, even if the Fed cuts the rates, there are other rates within the market that might go up.
I suppose the question that the Singapore investor wants to know is, what does this mean for your estimates of inflation and when it could go away?
I think it's here to stay. I think we're probably looking at some downward trend or the beginning of a downward trend right down maybe the second quarter of next year. We are already seeing some sectors within Singapore which is already contracting. I mean, there is some contraction. I mean, it's stopped. But everyone needs to understand inflation is one thing. Nominal price, where prices are at this point at the moment, might just stay. So if inflation has stopped, the price at what the previous inflation figures have pushed up to, say, from $1 to $1.50, that $1.50 might just stay. So that's what everybody needs to understand. It's even though inflation slows, that $1.50 for your cup of coffee still stays. It's not going to come off.
It should. It should. Coffee's too expensive these days.
But see, if it comes off, then it's deflation and it's not good for the market. So it's one of those. It's economics.
Okay. Why are markets doing so well? The major U.S. indices all gained ground last week, rising about 1% to 2%. The Dow Jones Industrial Average closed above 40,000 for the first time. Do you think the Dow is going to remain above 40K at least for this week?
Okay, I think everybody also needs to understand that why the American economy is doing well. It's also the media. It's also the very fact that the last four quarters, earnings per shares for American companies have been doing very, very well. So the guy in America, it beat expectations. So one of the reasons why inflation is questionable, inflation coming off in America is questionable, is because of the strength of the economy. And the Dow, the S&P 500, the NASDAQ, all three of them are actually proving this point. So last year, of course, we had the Magnificent Seven, but this year the Magnificent Seven are taking a backseat. Maybe not all of them. Three of them are taking a backseat. Four of them are still there. But the rest of the market's catching up. So when the rest of the market's catching up, the index is doing well. Number two, with higher interest rates, the dollar is also doing very well. I mean, everybody expected the dollar to be weak, and, since the dollar is doing well, you're seeing a lot of flows into America. So one of those flows is into the equity market.
Still on the U.S. economy, Goldman Sachs chief U.S. equity strategist David Kostin has stated his view that the S&P 500 is unlikely to deliver any additional gains through the end of the year. And he's raised several factors: valuation concerns, economic and earnings growth, outlook for the U.S., interest rates, monetary policy. Broadly speaking, Anand, do you agree with his view?
Well, yes and no. It's a yes and no. So I don't like to say, oh, it's going to go this much. It's not going to come out. This is it's very, very difficult to pick figures. What's really, really important, especially when you're investing in stocks or when we're looking at the equity market, is earnings. And if there is earnings growth, and earnings growth surprises, and companies basically can continue to grow, and earnings in the companies give you positive direction on where their earnings are going to grow, I think the market will continue to go up. I also expect certain sectors within the market to go up. So either there is a pullback on some of the bigger capitalized stocks within the index and a pull up of the other stocks in the index. I mean, there's 493 other stocks in the S&P 500 which could do well, or any sectors that could do well. And they could push the index up. So, I mean, for the Dow, there's 30 stocks. Everybody says it's a old, archaic index, but it's doing well because value stocks there. So as people pile into big cap value stocks in the Dow, that might continue to do well too. So it depends. I mean, if earnings grow, stocks will grow. If earnings stagnate, like what Goldman Sachs says, then it'll stagnate. If earnings come off, and the markets will come off. But earnings is very, very important. Earnings growth is very, very important.
Okay, so Goldman Sachs projecting real U.S. GDP growth of about 3% and earnings growth of about 8% for 2024. And I want to just peel it back to, what you mentioned earlier, that you do see some sectors in the direction of high growth, moving in that direction. Which sectors are these?
As we spoke earlier, it would be high-end technology supporting artificial intelligence. One. Number two, it'll probably be energy because we still need energy. And there is actually a third subsector which is quite important, and could be industrial water, because you do need a lot of water to actually cool your servers and cool your servers. You even need clean water to make semiconductor chips. So a lot of people fail to realize that industrial application of water is also very, very important. So there's some sectors, you need to understand these sectors which we need for the development of artificial intelligence. Really
interesting. I think this is the first time industrial water has been raised on this show. We'll have to do a whole show on that. And when we talk about high-end technology supporting AI, just very briefly, are you talking about hardware innovation like GPUs, TPUs? Are you talking about quantum computing, algorithms, software, data infrastructure, specialized chips? What are you talking about when you say?
So let's start with the base. So I think the last time we spoke, the last time we had the event together, I explained to everybody that artificial intelligence is where we are at the beginning of the internet, where we are at the PC level, or the Apple Mac level. So this is where we are at the AI, artificial intelligence development cycle. So we're at the beginning of that cycle. So it's all very hardware. So chips, keyboards, yes, CPUs, TPUs, GPUs, server farms, cloud development, data analytics, so the software side and the hardware side or the initial software side and the hardware side are where things are growing really fast. But you need to understand, it took the internet to basically hit everybody, maybe 2 or 3 decades. It's going to be much faster with artificial intelligence.
Right. Fantastic. Well, I'm really sorry that we're out of time because we could go on. Always great speaking with you, Anand. Thank you for being with us.
Thanks, Anand. Take care.
Anand Francis, a senior investment strategist at Infinity Financial Advisory. My guest today in Money and Me, I'm Michelle Martin.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.